So good morning and thank you for joining us this morning for our Domani Wealth seminar. As you are probably aware, the seminar will include an economic overview and thoughts on how you can stay strategic about your retirement planning in uncertain financial times like the one we are currently in. Before I get started, I would like to go over a few items for the format of today's event. First and foremost, I'd like to ask for your viewing pleasure. If you could please click the speaker view that's in your upper right corner. You should be able to see it if you hover in that top little section up there, and that will be able to optimize your viewing for the speakers and the presentation that will be started in a few minutes. All participants will remain muted with their videos off throughout the event. In a few minutes, I will ask that each of you introduce yourselves so that our speakers know who they're talking to and the company that you're with, and you may or may not turn on the video for that section of the seminar if you'd like. To submit a question during the presentation for the Q&A portion of the event, you can use the chat box and send your message. For those of you who don't know how to use that, there is a little screen at the bottom you can hover over, and there is a little box that says chat. Make sure that it is going to everyone when you submit a question, and we will be sure to answer those afterwards. You can also find that I've already included in-depth introductions of each of our speakers in that chat if you haven't had a chance to review it already. If you have any difficulties during this, you can email me directly at hbriggs@hanoverchamber.com. At this time, I would like to introduce to you the speakers. And first we have Ken Eshleman, CFP, Partner and Senior Wealth Advisor. Ken helps individuals and their families develop customized financial plans aligned with their personal goals and objectives. He collaborates with the firm's investment strategy group to construct clients' portfolios coordinated with their financial goals, cash needs, and appropriate risk levels. He also works very closely with nonprofit and institutional boards to gain a deep understanding of the organizations and develop customized investment plans designed to meet the client's objectives. And if you can just give a little wave there. Next, you have Chris Stock. Chris has his MBA, AIF, Partner and Senior Wealth Advisor with Domani. Chris Stock takes complicated financial situations and provides clear, objective advice. He's known for communicating in an easy to understand way with clients that are able to grasp and appreciate. He focuses on developing financial plans geared to each individual client situation, ensuring that the strategies and tactics therein put the client on a path to reaching their financial goals. He works with Domani Wealth's investment strategy group to monitor every client's plan, adjusting over time to realign the plan as needed. Chris? I know they probably know which one you are, but hey. And our third presenter will be Angie Stevenson, CFP, CPA, PFS Partner, Senior Wealth Advisor, COO. Angie works closely with individuals, their families, trusts, and charitable foundations to develop customized financial plans that are aligned with their personal goals and objectives. As a CPA with significant tax and consulting experience, Angie applies the specialized knowledge to various aspects of client planning, including estate, gift, business ownership, wealth transfer, trust, and foundation engagement. Angie? And at this time, if we could just quick go through, I'll say your name since I see the order that you're in. If you could just say hello and let us know who you're with. So we'll go ahead with Nancy Hess first. All right, Nancy, we'll come back to you. Michael Fink?
Yep. Can you hear me?
Yep, you're good.
All right. I'm here. Hi, everybody.
Hello.
Hey, just want you to know that Chris's golf game stinks. So just want you to let you know that.
Thanks for joining us, Michael. Kayla, can you hear us?
Hi, everyone. My name is Kayla Kale. I'm with SEK.
Thanks for joining us. Matthew Gavel.
I'm supporting my folks at Domani Wealth because that's where I work. So, hello, guys.
Brian, can you hear us? Brian Warner, I believe, down there with the VNA. Angela Burakovsky.
Good morning. I am also a partner at Domani Wealth, so I'm here to listen to the sound advice and comments that Angie, Ken, and Chris are going to share with us this morning. Thank you.
Thanks. Michelle Bailey.
Hi, Michelle Bailey, also from Domani Wealth, Manager of Operations.
Thank you. Jessica Malhot.
Hi, I don't work with Domani Wealth. I actually work with the Lancaster County Community Foundation, and I'm a client of Domani. So anxious to hear all that we're going to talk about today.
Thanks so much. And just so everyone also knows, this will be recorded. We're going to be able to give that to Domani. They'll be able to post it. It'll be on our site as well. So please share that information. So at this time, we're going to go ahead, get started with Ken, and we're going to go ahead and get the presentation popped up there too.
All right. Well, good morning, everyone, and thanks for joining us on the call today. And we hope that you find it useful. I'm going to get started and just do a little bit of an economic overview and kind of lay some groundwork as to how we got to where we're at today. And then,
can I interrupt you for just a second? Haley, can you do the screen share so I can share it? Oh, there we go. All right, I'm ready to share. Thanks all.
and then I'm going to pass it over to Chris. He's going to talk about the financial planning process and the importance of that, and also talk about some retirement saving techniques. And then finally, Angie's going to finish and talk about some tax saving techniques and some other unique planning tools, and then leave you with some action items. So, so first I'll get started and just kind of talk about, how did we get here? And, it's kind of interesting. If you try to think back to January or February, it seems kind of unreal that you can't even think about what it was like then, but it was normal, so to speak. And at the time, we were talking about, what's going to cause the next recession? Is it going to be trade negotiations? Is it going to be geopolitical tensions between China and the United States? Or maybe it's going to be Brexit? No one was thinking, obviously, that it was going to be a global pandemic that was going to cause the next recession. And in fact, that's what occurred. So you can see there, when the cases started in about the middle of March and escalated through April. And I think what's interesting to me when I look at this, because we did this, a similar presentation back in the middle of June, so about 2 months ago. And this chart's interesting because at the time, you didn't see how it's gone back up over the summer months. So we've actually had a lot more cases per week over the last few months than we did in the beginning. And I was looking at the numbers yesterday. The total cases worldwide now is over 5 million. And back when we did this in June, it was like 1.5, or it was 2 million. So it's more than doubled in the last 2 months. Pennsylvania has about 130 cases at this point. And it does seem like we're plateauing a little bit and coming back down. But so it'll be interesting as we go into the fall and, kids are back in school, and just to see how that progresses. So here we are, we got a global pandemic, and that's what initiated or started the recession, which is 2 consecutive quarters of decline in the economy. So, when this all started, one of the things that was a positive, or what was helpful, is there was a lot of stimulus that was initiated both fiscally and monetarily, which helped kind of keep the market going, or keep the economy going while we were basically shut down for the last 2 months. So the fiscal stimulus had to do with different phases. In the beginning of March, there was some money that was allocated towards treatments and testing and other types of benefits. And then the big one came at the end of March, the CARES Act, which you probably have heard about. That was a stimulus package that was over $2 million, or $2 trillion, I should say. And the big benefit to that, you can see in the circles there in the middle, there was a lot of money allocated to individuals for unemployment benefits. Everyone got the $1,200 check. There's corporations that were loaned to, like in the airline industry. And then down below in the bottom, where it says small businesses. You might have heard about the PPP, or Payment Protection Program, and that was a stimulus to help small businesses keep employees on the payroll. And so that's what's kind of kept things afloat. It's been a big safety net to keep us going. The downside, of course, is, now we're about $26 trillion in debt. And, at some point, we're going to have to pay for this. So we'll see how that all plays out. But there is going to be, the expectation is there's going to be another stimulus package. The initial thought was that it would be passed by the end of August. Now, it doesn't look like that's going to happen. It looks like maybe it might be the end of September now, as we get closer to the government having to approve a budget. You probably saw that Trump did some executive orders that were signed a week or two ago, but actually, I think there's only one state of Arizona, that has implemented those executive orders. So I think it was kind of just a show that actually isn't really going to impact or be enacted by the states. So that was part of it, the fiscal policy. And then secondarily, what happened is the Federal Reserve implemented monetary policy. And that's on the next slide. You'll see that a couple things. And when I show you these charts that are coming up here, I don't need to pay attention to the actual numbers or anything, but just kind of gives you an idea of where we're at. But what this shows you is what the federal funds rate is, which is the rate that banks charge to lend to one another. And you can see that the rate was lowered immediately. There was an emergency meeting that was in the middle of March, and the Federal Reserve lowered the rate basically to zero, so that to keep things afloat. They also restarted some asset purchase programs and other kinds of asset-backed security loan facility programs that were actually implemented back in 2008, 2009 for the great financial crisis. So basically, between the fiscal response and the monetary response, there was a lot of money that was injected into the system to keep the economy afloat. The next slide just shows you, typically, just to give you a feel, typically the Federal Reserve tries to target an interest rate of 2.5% as opposed to 0. So it's not something that we expect is going to continue forever, but it's the Federal Reserve has already indicated that they're going to keep interest rates low for a number of years, probably until 2021, 2022, quite honestly, until we see that the economy is starting to recover. And what that means to you when the Federal Reserve lowers interest rates is mortgage rates have gone down quite a bit, so you may or may not have looked at refinancing your mortgage. Basically all interest rates have declined significantly. And that's reflected too on the next slide. It shows you the Treasury yields. Just to show you, the top line was the rates at the end of 2019, and then the green line below is the current rates today. And you can just see that rates have gone down significantly. The 10-year Treasury, which is what a lot of people reference when they talk about interest rates, is 0.68%. And just to give you an idea, the average over the last 60-some years is almost 6%. So we are at historically low interest rates in the marketplace, but we don't think that we're going to go into negative interest rates. And you may have heard about that in some other countries like Japan, where there is negative interest rates. So on the next slide, what happens is you'll see we basically, before I get to that, I want to talk about inflation a little bit. The other thing that occurred when we started with this pandemic is that there was a tremendous fall in energy prices. And so inflation actually went down quite a bit. And now we're hovering around 1%. Well, the Federal Reserve likes to target an inflation rate about 2.5%. So we're at very low levels of inflation. Now, it looks like that started to pick up a little bit over the last month, but we don't think We don't think certainly we don't think that it's going to be a deflationary type environment. We do think that, inflation will eventually start to pick up because of all the stimulus that's been injected into the system. And that's one of the reasons that you've started to hear about gold and commodities, is because oftentimes gold and silver and other types of real assets that are used as a hedge against inflation. So that is probably going to start to creep up over time, but not for a while. Now on the next slide shows you the impact of the shutdown on the economy. And when you hear in the news people talking about the economy, you always hear about GDP, which stands for gross domestic product. And what that means is what is actually produced in goods and services within a country. And going back to 2016, you can see that we were kind of chugging along around 2.5% growth. And then in the first quarter, just by shutting down the economy, basically the middle of March, the last 2 weeks, the economy declined by about 5%. And then the second quarter was the worst, when basically everyone was shut down. And you can see that we actually fell about 33%. The expectation is that in the third and fourth quarter, we're going to start to see an increase, but it's not going to be like a tremendous spike that all of a sudden we're going to be, growing like we were before. I think it's going to be a slow process, kind of like a muddle through type scenario, as businesses start to get back online. But I think for the time being, until there is a vaccine, people are going to be reticent to travel and other types of entertainment that was done in the past, with sports being a good example of that. On the next page, what I want to show you there is just the unemployment rate. And what transpired, of course, is there was a lot of unemployment that occurred. At the end of 2019, we had reached a point where unemployment was below 4%, 3.5%, almost at historical numbers. And it shot right up. I think it got as high as 14 or 15%. And now, as of the other day, it's back down to about 10%. And we do think probably that unemployment is going to stay in that 10% range. I think what will be interesting to see what transpires here over the next month or two is, as some of these unemployment benefits are not intact anymore, what is that going to mean as far as unemployment goes? But the expectation is whenever there is a stimulus package that's approved, the next one, that they're probably going to extend the unemployment benefits. Pennsylvania has a little bit of higher unemployment rate. It's close to 14%. And I saw that York and Hanover is in the 11.5% range. So we're going to have some elevated unemployment for a period of time. And then finally, I just want to show you, and this is, I think, an amazing chart on the next page. It shows you the S&P 500, which is the 500 largest companies in the index. That's often referenced. You hear the Dow Jones, which is 30 stocks. The S&P is 500 stocks. But if you had been asleep for the last 6 months and you woke up today, you'd probably like, oh, okay, so the S&P 500 is up about 7.5% year to date. Everything seems pretty normal. But as we know, it has been far from normal. The S&P actually declined in the months of March, April. I think it was 34%, which was historic as far as the decline and how quick it was. But now it's come back up, and we're actually closed the other day at an all-time high for the S&P 500, which is an interesting dynamic. And I guess what I like to say to folks is, if I didn't believe that you can't time the market before, I definitely believe that now. And it kind of leads into the next area that Chris is going to talk about, financial planning. Because a lot of times when you get kind of this hysteria, people kind of make emotional decisions and they overreact, or should I sell all my stocks? What should I do? How's this going to impact my retirement? And the key is to not be focused on the short term, because we know over a longer period of time, things will get better and things will change. And that's the importance of financial planning. And Chris is going to talk about that next. And so I'll pass it over to Chris.
Thank you, Ken. That's a great segue. I think there's a lot of truth in what you just said there at the end of that slide, in that the focus really should be on what your plan looks like and not what the rate of return is in that particular month or quarter. So I'm going to spend some time talking about the financial planning process that we believe everybody should be participating in with their financial advisor. You should be running what we call a retirement plan or a retirement projection. It can be an intensive process, but it really forces you to look at all parts of your financial picture, which is a tremendous value in understanding what your goals are and whether or not you're on track to meet them. As you'll see, some of the common questions could include, is my planned retirement date still realistic? Can I retire earlier, or do I have to work later? You really need to run the numbers to see what that looks like. How does your portfolio risk with stocks versus bonds affect your retirement date? Should you increase your portfolio risk level, or does the plan look so good that you can actually reduce your risk? Will your money last through normal life expectancy? What is your expected life expectancy based on your own family history or your current health? Can you help out with education for your children or grandchildren? And down there towards the bottom, if you're not on track, should you reduce the amount of money you're receiving to increase your probability of retirement success? The term probability of retirement success is something that's part of the planning process. You want to kind of figure out whether you're on track or not. And finally, the CARES Act that Ken had mentioned earlier allows you to forego your IRA required minimum distributions for this year. Are you able to do so based on your financial plan? On the next slide, we talk about the importance of finding an investment firm that has a highly credentialed team of professionals that can put their expertise to use for you. These credentials can include CFP, certified financial planners, or CPAs, or certified public accountants. CFPs and CPAs provide specific tax expertise and tax planning strategies for your financial picture. The first step in the planning process is what we call data gathering. This is where we accumulate all of your investment statements, tax returns, insurance policies, estate planning documents, etc. A lot of information. It may seem like a lot, but it's important to make sure that all facets of your picture are working in tandem. Can't tell you how many times we see things that are disjointed, meaning that you may have a great estate plan, but your investment accounts don't have beneficiaries that match your estate plan. It's just one of countless examples that we can provide in that scenario. The next slide is looking at your specific financial goals. What is your ideal retirement date? How long would you work if you knew your retirement picture would look better? What sources of income do you have, such as pensions or rental property income? And how much will your Social Security be? Have you considered health insurance? If retiring prior to age 65, how will you and your spouse be covered for health insurance needs? As you may or may not be aware, it's very expensive to get health insurance if you're not working for a major employer in this country. Do you have any specific travel goals? And would you like to buy that dream vacation home? Do you have any charitable or philanthropic goals, or any specific bequests to children or grandchildren or charitable organizations? And how would that affect your retirement picture? As you can see, the conversations around these topics can be extensive, but really allow your financial planner to understand your entire financial picture. It's invaluable to us because we're able to provide specific personalized advice to our clients by getting to know them on this level. The next step is the monitoring of your plan. There are many life events that can change your picture in a dramatic fashion, sometimes overnight. A good financial plan is able to be easily updated as these life events occur. Doing a plan one time is not the answer. You really need to create that baseline and then have periodic updates. Periodic could be annually, could be every 2 or 3 years, or when a life event occurs. But It is a changing plan over time. There are quite a few planning techniques that can be applied in each of these life event scenarios. So it's important to have someone on your team that can guide you through these decision points. These decision points can include Social Security, Medicare, pensions, beneficiary designations, just to name a few. And they can all be affected with a divorce or a marriage or having children. I mean, all these life events affect all of them. No matter what your age is or whether you're still working, and you probably are wondering how much you'll need to retire, or how much, if you already retired, how much will you need to sustain your current living needs. The question I say is, what is my number? There are many rules of thumb out there, and you'll see on the slide here, we have some rules of thumb that can be general guideposts. To really know for sure what your retirement target is, you really need to do an in-depth analysis with your financial planner. You'll see from the slide how many times your salary will need at 3 different ages, which can seem like a large number. The sooner you determine where you are, the easier it is to make meaningful changes. What I mean is that walking into our office at age 65, after you retire, is not the opportune time for planning. Ideally, you would have begun those discussions long before that and had a good handle on whether you can retire before the decision is made. The next slide, some of the many planning strategies that can be employed include taking advantage of your pre-tax savings first, which can save you significant dollars in a year of contribution, getting the pre-tax deduction for tax purposes. But you can also defer your tax bill until you begin withdrawing the funds in these pre-tax accounts, meaning that money that's in your 401k or IRA is not taxed each year, continues to be deferred. It's also important to take advantage of your employer match. I think that's probably the one thing in this country that a lot of people miss out on. A lot of younger people are not taking advantage of that. If they have to get the 6% to get 3% match, they're not getting there, and they're leaving a lot of money on the table. If you have a 401k, 403b, or simple IRA through your employer, you should certainly not miss that opportunity. You can also look at IRA contributions and whether they're deductible for you. Do you qualify for Roth IRA contributions, or is your income too high? Is a backdoor Roth strategy available to you? It's important to work with a CFP or CPA to make sure you do these strategies correctly. You also should be saving to personal savings accounts or after-tax investment accounts. These accounts provide additional flexibility in retirement when managing your tax situation, meaning that you want to have 3 different buckets. You want to have the pre-tax tax deferred, you want to have the after-tax tax-free, you want to have the after-tax taxable. And by doing that, you can keep yourself in hopefully a lower tax bracket each year in retirement. And the last item on this slide is HSAs, or health savings accounts. We believe this is an underutilized strategy that's available to many folks today. You would need to be in a high deductible health insurance plan to access an HSA, but the plan provides triple tax advantages if used for health costs, meaning the money goes in pre-tax, it's tax deferred, and then can come out tax-free if used for health costs. For those that have some time before retirement, there's actually a strategy that you can use to actually leave the money in there and let it grow tax-free. We feel that for younger folks, if they can max the HSA and then pay their medical bills out of their bank account, they're creating another retirement asset there that can be used for health costs. The next slide is on the, we call the safe withdrawal rule, and how it applies to how much you can withdraw from your portfolio each year and still sustain your portfolio through a normal retirement. There have been many articles written about safe withdrawal rules. In fact, the safe withdrawal rule of 4% was common not that long ago, but due to low interest rate environments we're in now, 3% has become the new number. And Ken had referenced that on numerous slides about how interest rates are so much lower now than they were 10, 20, 30 years ago. Back when money markets were paying 5% and bonds were paying 6 to 7%, it was much easier to achieve a return high enough to sustain a 4% withdrawal rate. But with interest rates so low today, it's much more challenging because as we know, we're getting very little return on bonds or cash. The slide also says that for a $1 million portfolio invested in a moderate risk level, you could sustain a $30,000 annual withdrawal. It also assumes that you would increase that withdrawal for inflation over time. And typical inflation is around 2.5% per year. Though as Ken mentioned previously, 2.5% is not where we're at today. We're actually a lot lower than that. But again, this is another rule of thumb. So it is very general. You need to make sure that you probably have a financial plan run to understand your situation fully. I would never just go off rules of thumb from my own financial picture. With that said, I'm going to turn it over to Angie Stevenson, and she's going to go into some tax saving strategies.
Thank you, Chris. So you've heard from Ken about the economic picture that we've had year to date, what's happened with the stock market, and then you've heard from Chris about the importance of financial and retirement planning. So my section today is to sort of talk about the combination of the two. One, we like it when people can keep as much of the growth in their investment accounts as possible, meaning paying as little taxes as reasonably possible. And also from a tax planning or from a financial planning perspective, to consider the tax ramifications of all your goals and objectives. So we try real hard to put all of this together so that we have a tax efficient portfolio management approach. And in addition, when our clients are looking at different planning techniques, we consider the tax ramifications of those. So today we're going to talk just about a few. There are many, so we don't have enough time to go through everything, but we thought these two might be current and appropriate for the time that we're in. The first one, and I think Chris alluded to it, is anyone who was over the age of 70 and a half, and now the law changed in 2020 to age 72, needs to take required minimum distributions from their IRAs or retirement accounts. We refer to them as RMDs. Based on the pandemic and the CARES Act, the RMD has been waived for 2020. So some people took distributions from their IRAs prior to the law being passed. And for right now, if you want to pay it back, you have until Monday, August the 31st to repay that RMD. There's a lot of good reasons to repay it. I think Chris also alluded to, it depends on your personal circumstances, whether your other assets are substantial enough to cover your living expenses, to allow you to pay it back or not take it. And also there's some tax reasons that sometimes there might be a reason that you continue to take part of your distribution if you're in a lower tax bracket or you've got some deductions where you need income to offset it. But I would say that probably for the vast majority of our clients, we've paid it back by August 31st. The other area that we want to talk about today is tax loss harvesting. Now, this is very appropriate for this year. And, you know, it's really bad to watch the volatile markets that we experienced earlier in the year and watch the value of your statement in March when it came to you, see how much it dropped. But it's even worse to experience that and still pay taxes. So we view volatile markets as almost opportunities to help with current tax situation and future tax savings. So in March, I'm sure all of us could have looked at our portfolio and seen an investment that the value in March would have been less than what you paid for that investment, okay? And that to us is an opportunity. It is an opportunity to sort of shift out of a position that is showing at a loss, realize that loss, recognize it for tax purposes, but at the very same time, we're going to purchase an investment that is similar to the one that we sold, okay? It cannot be the exact same investment for tax reasons, and we'll explain that in a minute, but it allows us to book that loss and offset capital gains that you may already have. And if you can't use those capital losses this year, you could use them in the future because they are allowed to be carried over as long as you live. So going to the next slide, we'll go through an example because you're probably saying, how does this work? So let's go through an example. Let's assume that you had a mutual fund in your portfolio, ABC Mutual Fund, and that you had purchased that mutual fund in January of 2019 for $20,000. The value of the fund in March fell to, let's say, $15,000. So the ideal here would be if we sell that ABC Mutual Fund, we would have a $5,000 loss, okay? Now, I want you to realize this is not a permanent loss as long as you do step 2, okay? We sell it, we recognize the loss, and on the exact same day, we purchase a similar investment. In our case, we're going to say the S&P 500 index might be a similar investment. So we take that $15,000 of proceeds from the ABC Mutual Fund and purchase the S&P index for $15,000, meaning that we're still invested in the market, guys. So in April, May, June, and now as the market has, rebounded, we're still invested. So it wasn't a real loss because we never took the money and didn't reinvest it, okay? But in return, what we've done is we've booked a $5,000 loss. It can be used to offset other gains that we might have this year, or if we can't use it all against those gains, and the IRS has some limitations about what you can use, it can carry forward, all right? Example, 2008 and 9 during the financial crisis, between mid-September of 2008 and probably the middle of the summer of 2009, we might have, I'm going to say, completed tax loss harvesting 5 to 7 times in client portfolios. And for most of those people, it meant that we had loss carry forwards that took care of, as you know, the market rebounded quickly and we started to see, growth again, mid 2009. Many of our clients didn't pay capital gains tax again until anywhere between 2012 and 2014. So what does that do? It allows you to keep more of that growth and pay less taxes. The strategy, it's a strategy that you have to pay a lot of attention to detail. You got to understand the tax laws. So it's something that if you haven't been doing, when you see volatile markets, instead of burying your head in the sand, oh no, what's going on? You need to think about this strategy. So we'll go on to the next slide. So we've already talked about this slide, basically talking about the capital loss. So the last slide that I have for you, and we don't hear a lot of people doing this. Lots of times when we have clients come in, they've never heard of planning for Medicare premiums. So let's talk about how Medicare premiums are set for individuals. Medicare premiums are tied to your adjusted gross income on your tax return. So if you are on Medicare right now in 2020, your Medicare premium for 2020 was based upon the adjusted gross income from 2018. It's 2 years prior, okay? And the reason it is because your tax returns aren't due, until the following year and until the IRS gets them into their system and can share it with Social Security. It's about a 2-year period where they can match this up. So there are a couple of things to think about on planning for Medicare Social Security. There are what we refer to as life-changing events, to where you can file an exception to your income for the Social Security Administration to consider reducing your premiums, okay? The difference between the lowest premium and the highest premium per individual is as much as $400 a month. That's per person. So if you're a couple, it's $800 a month. So we consider this in many life events, okay? One is retirement is a big one. Retirement, when your wages are going to go away, that's a big one. And we'll go through an example of how that can affect an individual. Death could be another example. A spouse passes away. And now your Medicare premiums are based on 2 years prior when both of you were filing a joint return. So that may require a reset and a filing of an exception with the Social Security Administration. We just had one. We had two, unfortunately, in the past couple of weeks. Chris and I spoke yesterday. We had clients that were Medicare age that got divorced. For whatever reason, that segment of the population is starting to see more divorces. So when you get a divorce similar to death, you can potentially reset your Medicare premiums for that. Also, the sale of a property that is income producing. So if you were, in business, you had a medical practice and you owned that building, for example, and rented it back to your practice, and then you retired, and a few years later, the owner of the medical practice or the physicians remaining in the medical practice decided they wanted to buy that building from you. That could be considered, the gain on that property could be considered an exception because it's the sale of an income producing property. So very, very key to think about timing of when you take in gains between years, and the brackets of, when you get to that highest level of premium, it might be, the difference of taking a $10,000 capital gain in December versus waiting to January, because it might bump you into a new category, costing you, $100, $200 more a month. So going to the next slide. We're going to go through just an easy example because a lot of people are not aware of this planning opportunity. Let's assume that we have a married couple, and the married couple retired on December 31st, 2019. Their combined wages prior to retirement were $140,000. Their adjusted gross income in 2018 was $180,000. So remember what I told you, 2020, the premium is based on 2 years prior. So that would be the 2018 tax return. So after retirement now, 2020, if you look at what these people will earn, their wages are gone. Okay, so that's a life event, retirement, and their wages have disappeared. They will have Social Security and a small pension and their investment earnings. So after looking at this with this client, we determined that their new AGI level will be closer to $100,000 versus $180,000. So based on their 2020 Medicare premium, if they would have just looked at their 2018 adjusted gross income, their combined medical premium would have been $429 a month in 2020. But if you look at the $100,000 adjusted gross income, their premium is $289. So that's a difference of $140 a month or $1,700 for the entire year. So we try to keep this in mind when there's a life event, a life change, something for you to consider if you're already in Medicare and you're newly retired and you haven't looked at this exception. You might want to talk with your financial planner, your CPA, to get some advice on the paperwork that needs to be filed with the Social Security Administration. So that's it for the Medicare premium planning. So we want to conclude today with just going through some highlights of what we hope you take away, some action items. I think it's easy to say after listening to today, it's never too early to start saving and planning for retirement. Even if it's a small amount and you're in your 20s, the sooner you start, the easier it is to accumulate, and it does accumulate quickly, especially if you're adding money into 401ks and retirement accounts. We want you to take that advantage of tax deferred savings. Your employer match is so important. Your employer match is 3 to 5%. If you put in 3 to 5% of your own money, you double your money by taking advantage of the employer match. So we definitely hope that people are taking advantage of that. We ask that you consider saving in a personal investment account. This helps supplement your retirement assets. It also somewhat gives you more of an emergency fund if you need to, access funds. And it also allows you to have more of a balanced approach to your income stream in retirement, to have both ordinary income from a retirement account and potentially capital gain treatment from a personal investment account where the taxes are much less. We also ask that you consider, when you're doing your planning, if you have to choose because, your finances are limited, that you can save for college for your children or retirement, you probably want to consider retirement first. College can always be funded in other ways, loans, and other vehicles, but you want to consult with your advisor because you do not want to shortcut or shortchange your own retirement goals. Next slide. We want you to consider the waiver of the RMD for 2020. Talk to your CPA, talk to your financial planner. We also remind you that investing in a diversified manner for the long haul, the long term, is absolutely the smoothest. It gives you the smoothest ride. You want to avoid the temptation of market timing or taking extreme bets. This year, the market for technology has been very tremendous. And even our own clients are like, why can't we buy, more Google, Amazon, Facebook? Yes, you have all of those, but you don't want to put all your eggs in one basket, because while it goes up at periods of time, it also goes down. So having that diversification allows for your investment portfolio to ride out more smoothly these volatile periods. We also mentioned to people that we think that they should have an automatic savings from their wages. Just like you have an automatic deduction from your wages to go into the 401k plan, you should have an automatic deduction going into your investment or bank savings account. This allows it to be automatic. I don't know about you guys, but if it's out of sight, it's out of mind for me. So if it doesn't come into my bank account where I write my bills and pay my living expenses, I tend not to miss it. I see that number 7 is missing on the slide, and we are talking, in this slide, we were talking about risk. In this slide, we talk about that sometimes the reason people don't hit their goals as they reach retirement is they don't take enough risk in their portfolio when they're younger. So when you're in your 20s and your 30s, most people have another 30, 35 years to work. So taking risk in your portfolio, meaning you can allocate more to the stock market in those earlier ages, allows you a long period of time to rebound. So not worrying that, you're too conservative in your early 20s and 30s, is really important to long-term growth in the portfolio, because as you get closer to retirement, that's when you want to dial back the risk. Going to the next slide. We want you to remember to increase your savings when you receive a compensation increase. It's always real easy to forget that. So if at the end of the year you go in and your employer says, we're going to give you a 5% raise, it's very nice to share that raise with all the buckets of your savings. So if you increase, if you're not already maximizing your 401k, it's a great time to add a little bit more to your 401k plan. It's a great time to add a little more to the personal savings that's going into an investment account or bank account. And then you still share in that compensation increase in your paycheck of what you're going to spend. But it's an easy way. You've never had that money before. And generally speaking, if you do it right away, most people don't miss that increase. Chris mentioned, when you do a financial plan, it's not something you do and put on the shelf and hope it works and look at it in 20 years and go, oh gosh, I hope it works. You've got to make that plan. You've got to revisit it. You've got to monitor it for lots of reasons. Sometimes your goals change. Sometimes your financial picture at work changes for the good or for the worse. Also, economic changes and tax changes. So there are all kinds of reasons that if you're not revisiting this at least annually, having that checkup, you should be doing so. We also believe you've just heard from all of us. You've heard about the economics of a portfolio and investing. You've heard about the reasons for financial planning and what to do. And you've heard about some tax reasons that, you know, certain planning items maybe help you retain more of your growth. We believe that you are best served by finding a professional organization that has experienced professionals with certifications and experience that includes CFPs for certified financial planners, CPAs, CFAs, chartered financial analysts, and we also work closely with our clients' other advisors. We work closely with CPA firms who are preparing your tax returns, and we work closely with your attorneys on many estate planning items. So please consider that when you're deciding, you know, how you might do your planning. And also, again, try to invest in a tax efficient manner. If your advisor hasn't talked to you about this, ask them. Ask them, what are they doing? Did they make tax loss harvesting shifts in March? You know, how are you planning for the future to retain the growth when the market continues to improve? And finally, during volatile periods, find those blinders, put them on. You know, don't get emotional, stay the course. Unless you were taking too much risk, you know, putting those blinders on. Who would have ever believed in March when we were sitting with the Dow at 18,000 or so that we would be looking at the growth that we've had, the rebound. We've rebounded and recaptured in the Dow what we lost through March. So no one would have believed that if they would have let the emotions of what was happening in the market and in the health matters take over. So try to avoid that. Stay the course with the blinders. And we can't say it enough. Start planning early and plan often. We're so happy to have the opportunity to present to you today. If there's any questions, you know, we're happy to entertain those. Thank you.
If there are, go ahead.
But I have one question that was presented. Do you want me to state it?
Yep.
And then go from there. This attendee asked, if I sell the Vanguard S&P 500 fund at a loss and I buy the Fidelity S&P 500 fund, would that allow me to take the loss for tax harvesting? It's a great question. We frequently get questions like this. The answer, unfortunately, in that case is no. And it is not because you're selling a Vanguard fund and buying a Fidelity fund. It is because you are selling an S&P 500 index and you're buying another S&P 500 index. They're the exact same position. The only difference is that Vanguard is, you know, producing one and Fidelity is producing another. So from the IRS's perspective, they would view that as a wash sell and indicate that you basically bought and sold, or you sold and repurchased the same exact investment, and the loss would be negated.
Thank you, Angie. Are there any more questions at this time?
Done?
All right. Well, thank you all for joining us. On behalf of the Chamber, I want to thank the Domani Wealth staff for hosting. And as a reminder, this will be posted on both the Domani site and as well as ours. So if there's anything that you might want to recap, please reach out and you can check that out. And once again, thanks for joining us, and thank you to our presenters.
Thank you.
Fine.